When Michael Burry makes a move, investors pay attention. He's not just another Wall Street trader. He's the man who predicted the housing bubble in 2008 before it became the largest real estate crash in history. That single trade earned over $700 million for his investors and more than $100 million for himself. Before that, he made millions shorting the dot-com bubble. After that, he profited from shorting Cathie Wood's ARK Innovation ETF during the 2021 tech crash. Love him or hate him, Burry has repeatedly shown that he has the courage to go against the market when others are blinded by emotion, and he has the track record to prove it. Now, Burry is back with new trades revealed in Scion Asset Management's 13F filing, which acts like a cheat sheet of every stock his fund bought or sold in the last quarter. And what we're seeing is fascinating. His latest bet has already made him tens of millions of dollars in profit, but more importantly, his broader portfolio reveals a playbook for investing in today's volatile market. UnitedHealth Group, UNH, Burry's $42 million jackpot. Let's start with the trade that everyone is talking about, UnitedHealth Group, UNH. Burry bought more than $6 million worth of UNH stock directly, but the real kicker was his $109 million in call options, a leveraged bet that the stock price would rise. And rise it did. To understand why this trade worked so well, we need to go back a couple of years. UnitedHealth was the largest health insurer in America with a market cap of nearly $500 billion. But in December 2024, the company lost its CEO in a messy and very public exit. Investors panicked, and the stock price collapsed, falling as much as 60% from its highs. While the headlines focused on chaos, something interesting was happening behind the scenes. Warren Buffett, the world's most famous value investor, was quietly building a position in UnitedHealth. For months, no one knew. But when Buffett's stake finally became public in August 2025, the stock surged almost 40% in a matter of days. And because Burry had already placed his bet before the Buffett news broke, he walked away with as much as $42 million in profit in just a few weeks. That's the kind of timing most investors can only dream about. But the story doesn't end there. UnitedHealth still looks cheap today by one of the most important valuation metrics, the price-to-earnings ratio, PE. At just 13.4, UnitedHealth is the second cheapest of the top 6 health insurers. On top of that, UnitedHealth is considered a defensive stock, meaning it tends to outperform in market downturns. That's critical when you consider that Buffett is hoarding his largest cash pile ever, Ray Dalio is warning about U.S. debt, and Burry himself has a history of hedging against market crashes. UNH is not just a growth bet, it's also a hedge. The risk? If the entire market takes a dive, even defensive stocks will feel pain. But compared to most overvalued tech names, UNH still has significant upside left. Regeneron Pharmaceuticals, REGN, riding Dupixent's growth. Burry's second big healthcare bet is Regeneron Pharmaceuticals, REGN, where he holds more than $100 million including options. Like UnitedHealth, this stock is beaten down about 50% in the past year. But again, Burry sees hidden value. The company's growth is anchored by 4 major products, the biggest of which is Dupixent, a treatment for inflammatory conditions. Dupixent sales grew 21% year over year, and the drug recently received new approvals in the U.S., with applications pending in both Europe and Japan. That's a blockbuster in the making, and investors may not be fully appreciating it. Valuation models back this up. Based on discounted cash flow, the same method Warren Buffett uses, Regeneron trades at about 20% below fair value. For a pharmaceutical company with multiple growth levers, that discount is huge. Bruker Corporation, BRKR, the under-the-radar medical play. Another healthcare bet in Burry's portfolio is Bruker Corporation, BRKR, a company that builds advanced research instruments for medical and scientific use. The stock has fallen hard, but Burry isn't alone in spotting opportunity. Ken Griffin's Citadel also recently built a position. Why? Bruker owns specialized research tools that could be attractive to larger medical technology firms. In other words, it could become a buyout target. On top of that, by price-to-sales ratio, Bruker is one of the cheapest companies in its industry. Discounted cash flow analysis pegs Bruker at 146% below its fair value. An enormous gap that could spell opportunity if the market re-rates the company or if an acquisition happens. Lululemon Lulu, a contrarian bet on a beaten-down brand. Moving away from healthcare, Burry made headlines by buying Lululemon Lulu, The stock is down more than 50% in the last year after slowing U.S. sales, brand controversy, and fears that its fashion-forward athletic wear was just a fading trend. On paper, this looks like a risky pick. But this is classic Burry, betting on emotional overselling. Despite the noise, Lululemon is still one of the strongest apparel brands globally with decades of brand equity, and valuation models suggest it could be 315% undervalued. If consumer spending stabilizes and the brand regains its footing internationally, this could become one of Burry's biggest contrarian wins. MercadoLibre, Meli, the Amazon of Latin America. Burry also bought into MercadoLibre, Meli, often called the Amazon of Latin America. The region's e-commerce market is still one of the fastest growing in the world. And yet, Meli has lagged behind U.S. tech stocks, partly due to fears of tariffs and political instability in Latin America. To Burry, that smells like opportunity. MercadoLibre continues to dominate online retail and payments across multiple countries, and long-term growth trends are still intact. Discounted cash flow models suggest the company could be trading at nearly 500% below fair value, though even analysts caution that such a large gap means investors need to be careful. Still, the setup is undeniable, a beaten-down stock in a growth sector with emotional selling creating entry points. Estee Lauder, EL, a lipstick stock ready for a rebound. Finally, there's Estee Lauder, EL. The cosmetics giant has struggled recently with weak international sales and rising competition, making it one of the cheapest major players in beauty by price to sales. But cosmetics companies often benefit from what's called the lipstick effect. Even in recessions, consumers still splurge on small luxuries like makeup. Estee Lauder remains one of the most dominant beauty companies worldwide, and if sales stabilize, the stock could see a significant recovery. So, what do all of these stocks have in common? Looking at Burry's portfolio, we can clearly see a three-part playbook by beaten-down stocks. Every stock he's bought is down, many by 50% or more. Exploit emotional selling. These aren't random cheap names. They're good companies with strong brands or products that the market is unfairly punishing. Focus on cash flow. High cash-generating companies like UnitedHealth and Regeneron give Burry downside protection. Cash is king in volatile markets. This is what makes his approach different. He's not just chasing AI hype or blindly shorting everything. He's carefully pairing defensive healthcare names with contrarian consumer plays, creating a barbell strategy that balances safety with big upside potential. Michael Burry has already pocketed $42 million in profit from his UnitedHealth bet. But more importantly, his trades reveal a way to navigate today's unpredictable market. While most of Wall Street is either hiding in cash or chasing overvalued AI stocks, Burry is proving that there are still opportunities, if you know where to look. The lesson? Don't follow the hype. Look for areas where emotional selling has driven stocks down more than they deserve. Focus on cash flow, and be willing to go against the crowd when the data makes sense. That's how Michael Burry invests, and it's why he keeps finding fortune when others miss it.